If you want to be a good investor, you need to understand what happens when things go horribly wrong. It doesn't get more wrong than the great crash of 1929, which led directly to the Depression. Last week, Andrew Ross Sorkin, the co-anchor of Squawk, editor-at-large of the New York Times Deal book, and author of Too Big to Fail, The Authoritative History of the Financial Crisis, came out with a new book, 1929, Inside the Greatest Crash in Wall Street History. It reads more like a terrific movie than a piece of historical nonfiction. Everybody's in it. So let's take a closer look. Andrew, congrats on the new book. Welcome to Mad Money.
Thank you for having me, Jim. I'm so appreciative. This is so much fun.
Okay, so first of all, one of the things that was just extraordinary in the book was everybody was in the end.
Everybody was in. I mean, the whole culture was in this stock market, and everything that was happening here on this floor had taken over the entire culture. It was remarkable.
When you start off with the anecdote about Groucho Marx, which a lot of people don't know, that he got trashed by it, but then throughout, there's all these famous people who we thought were so smart, who were on the wrong side of the trade.
Look, everybody in New York, every member of the elite, the billionaire class, and by the way, not inflation adjusted, there were billionaires in 1929. People were making millions of dollars. People were trading. There were brokerages all over the city. You could walk into a hotel and trade. It was unbelievable what was happening.
And it's clear from you that at one point you say, look, the not-so-millionaires and the millionaires got along. There was actually hope that maybe capitalism was going to make everybody a millionaire.
I mean, it was a period of great transformation in this country. I mean, you had automobiles, you had telecommunications, you had, radio, the hottest stock, the meme stock. RCA was the NVIDIA of its time.
Everybody was at RCA.
Everybody wanted to be in, and these guys were trading. By the way, there was a specialist on this floor who ran RCA, and he was the celebrity down here.
It's just great. But all these people come to life. You make them all come to life. No one comes to life more than Charlie Mitchell, who clearly is the persona of the person who got everybody in and kind of ended up doing okay. I know the trial, but he ended up doing better than everybody else that lost money.
Charlie Mitchell worked just down the street, 55 Wall, corner of Pine there, and he ran a bank called National City, become Citigroup. By the way, his home, he lived up on Fifth Avenue between 74th and 75th, what is now the French consulate. That was his house. They called him Sunshine Charlie, and he was the guy who really created the idea of modern credit, that you could get a loan to buy stock. And he talked a lot about democratizing finance. He was Sunshine Charlie.
I know, and I talk a lot about democratizing finance, but I always have to be sure I don't run afoul of what he did, because I want people to invest.
Right.
And you do mention a book about Confessions of a Stockbroker that meant a lot to me in my first book. But I do want to point out there were some people, Leffingwell was a partner at J.P. Morgan. He comes off as someone who actually recognized that maybe things were getting crazy.
Oh, by the way, there were a lot of people who thought things were getting crazy. Charles Merrill of Merrill Lynch,
of Merrill Lynch,
1928, told people to get out of the market. Now, interestingly, the stock market went up from the beginning of 1928 to September of 1929, 90%.
Yeah. Oh, throughout it, you have these guys who kept calling the top, and they look so stupid.
I mean, that was the thing.
Right.
Timing is a very complicated thing. And then you had a guy named Carter Glass, who I think a lot of people know, who creates Glass-Steagall, which is the bill that breaks up the banks in 1933. He was like the Elizabeth Warren of his time, and he was railing, screaming about this idea of Mitchellism, how Charlie Mitchell was going to upend the entire country.
But in fairness to Mitchell, and I don't like to say anything good about him, Irving Fisher, this Yale economist, the #1 economist in the country, was saying we hit a good plateau, right?
Absolutely. That was the thing. I mean, and by the way, that's what makes a market.
Right. Well, it's just a great tale, because one of the things that people didn't realize, it wasn't like there was one day. That month of October, which you detail, was just horrendous. And the market came back, but it never got back.
So that was the interesting thing for me. I think most people think there was like one terrible day in October, and by the way, then the Great Depression just happens. And it's just not true. It's a series of dominoes, if you will, and then a series of terrible policy choices in Washington afterwards about how to deal with the ramifications of it. And interestingly, the stock market by the end of 29 was only down 17%.
Wasn't that something?
Isn't that something? And so, but
where they got in, where people got in.
Where people got in, and the fact that they were, 10 to 1 in terms of the margin, So you had so many people like Groucho Marx who get a call in October and he's effectively mortgaging his home. And so many people were hit so badly.
All right. So I do need you to compare here.
Yep.
All in now versus all in then. What's the difference? And maybe it parallels?
Okay. So the good news is there was no SEC then.
Right.
Insider trading. By the way, that was okay. That was fine. There was no capital requirements. There was no Banking Act. A lot of the rules that hopefully are the safeguards that have kept us safe for the last 100 years are been in place as a result of that. I also like to think a lot of the lessons that we learned in 29 were learned, by the way, in 2008 by Ben Bernanke, who, by the way, his PhD at Princeton was on the Great Depression. And what was the lesson? You have to, unfortunately, throw money at the problem.
Right.
Don't pull back.
Hoover was so against that.
They were
Mellon, oh my God, he had the most conservative group of people. But you detail all this stuff.
So you're in the room with these people, and you actually get to see the decisions.
And I did feel like I was in the room.
I mean, to me, just that was what I was going for. Right. That if you could actually see the way they were feeling and why they thought what they thought, it makes it understandable. You can.
Okay. I wasn't going to say this in a minute. I felt sympathetic for Hoover. I'm not kidding.
Yeah.
I think Hoover was the zeitgeist. He was trying to do what's right. He knew that people were bad off, but he didn't know how to. He felt just, you toughen up.
He thought it was a psychological problem.
Right.
He thought he could jawbone his way out of this thing. But he also then made a bunch of poor choices. He decided to raise taxes at the worst time.
No, he did it all wrong.
By the way, the tariffs, talk about parallels.
Smoot-Hawley
tariffs, we have them now. So there are things that are happening in our economy, too, that we need to watch out for as well.
Absolutely. Well, okay, if you were fascinated by the markets and fascinated by history, this is it, okay? Andrew Ross Sorkin, co-anchor of Squawk on the Street, author of 1929, which is on sale now. Hey, listen, you can mark it up like I did and get a lot out of it. Mad Money's back into the break.
God bless you.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.